right, we're live. Welcome to Tax Tuesdays, guys. We're still working out a little bit of visual. I hope everybody can see us okay here.
Wouldn't want to miss us.
Yeah, you wouldn't want to miss our pretty faces up here. It's not about the tax knowledge. It's about us telling you tax jokes, right? So, but welcome everyone to Tax Tuesdays. Bringing tax knowledge to the masses. You guys know the buzz line. I'm Barley Bowler. I'm the CPA, one of the CPAs here at Anderson, one of the tax advisors. We're joined by Mr. Elliot Thomas.
Hello.
We are back every other Tuesday. You guys know the drill. This is your questions submitted. And as we always say, Elliot reads all of your questions. He really does.
I do.
Put them in a pile.
Try to make a great Friday night in Vegas.
Yeah, totally. You want to know what we do when we're sitting down at the blackjack table on the side or count through tax questions. But of course, Elliot always does such a great job of compiling them in a way that is kind of has a little bit of a flow, right? This tax stuff is hard enough, right, guys? So we want to try and hash it out in a way where it follows some sort of, some congruency, a little bit of consistency as far as the questions go. So we're always attempting that. But as usual, these are your questions. Thank you for submitting them. We really love this kind of engagement. This particular forum, Tax Tuesdays, has been going on for a little while now.
Yes, quite.
Right. This might be one of the
about 11 years almost.
Right, one of the more long-standing kind of formats that we've delivered consistently for you guys. What that really tells me is it's a good format for you guys. It kind of instead of we're just going to go over some broad tax concepts today, it's more the rubber hits the road a little bit, right? This is my specific situation, specific question. And the chances of you being the only one in that situation are very low, right? We got a lot of people, small business, real estate, a lot of the same needs.
And a lot of these questions, yeah, there are repetitive questions, along the same lines. So that's another factor what gets them on the show.
Yep. So that said, we got our Tax Tuesday. You got the lay of the land here. We got the live Q&A feature in Zoom. Please submit any questions there as we go. Any questions you have, I mean, put them on topic and we'll try to discuss them as a group. But, anything that comes to mind, you can certainly shout out in the chat there. Just, of course, as an aside here, you have the Platinum portal for submitting written questions as well. We like that because we can look up your client profile, get some more detail there. Of course, we have the live Platinum Knowledge Room, 5 days a week, 5 hours a day. Yes, that does mean you have a CPA and an attorney on call 5 hours a day, 5 days a week. So brag to your friends about that and then use that service. Come in and ask any questions you have, tax, legal, all of the above. We got a nonprofit open office hour, a bookkeeping open office hour, how to be a good landlord open office hour. Tons of great material there, Platinum Knowledge Room. But as far as Tax Tuesdays goes, let us know what questions you have in the Q&A. Any feedback for us in the chat. If you can't hear us, can't see us, or I guess if you can't hear us, then
at least we can't
wave your arms or something, I guess. But
speaking of the PQs, we have just to run through. We have, of course, Patty's always helping out in the background. We got Dutch, Harry, Jared, Jeffrey, Tanya, and Troy. I think Troy's doing our YouTube, so we're there too. We're everywhere.
Right? Yeah, YouTube, fast paced on there. I know you guys have a lot of great questions on there, but yeah, thanks to the team in the background. Got some great experience in the background here, guys, from tax preparation, all across the board, CPAs, EAs, in the chat answering your questions. If you need a more detailed response, we will suggest that you become a tax client. You can do one-on-one tax planning with us, right? Anytime you hear somebody say you want to do tax planning with a CPA, you can do that with us if you're a tax client here. Certainly a service that we offer. Fast, fun, and educational. You guys know the deal. Toby, Clint, Michael, they really did start this with we're just going to tell you all the information that we know about this. And again, if you have a specific situation, hire us for your services, right? Kind of this is how they approached this from back in the day. But this has been, Toby's got 1,000 videos on YouTube.
Yeah.
Tons of educational content, all free, of course. So
water, please meet our friend Fire Hose.
Right. So, yeah, if you need some educational materials, and of course we commend you guys for learning legal and tax all at once. It's certainly a lot. So that said, any announcements we want to make? Anything we want to hop over there?
Just a reminder, excuse me, we're going to have our in Vegas TAP event coming up.
Oh, yeah.
Live.
Close.
We'll be
less than a month away.
Yeah, I believe it starts on the 11th, 12th, and 13th. It's a Thursday, Friday, Saturday.
Yep.
Going to be at our Durango Casino, brand new. And we'll be there.
That's right. We'll be there answering questions. I'll be there on Saturday, maybe during the week too. It's going to be fun. Lots of questions, lots of synergy. Come meet your tax advisors plus your fellow entrepreneurs.
Absolutely.
Yep.
It's a great time.
Yep.
All right.
All right. Any other announcements there we want to go over? Good to go?
Nothing we want to admit to.
Right, right. Well, let's hop into the opening question. So we're going to read through the questions here, guys, just to give you an idea of what we're going over today. Then we'll hop right in and get into the details. What is the maximum that can be contributed to a solo 401k Roth? Ooh, that's where we get these massive contribution limits, huh? As the employee and employer, because remember, you're both for a corporation that you own and control of my own business. What do I need to do to handle payroll for myself? Not handle payroll for yourself, but we'll definitely be covering that. What do we got next?
I want to loan cash from my business to myself since my spouse and I have regular W-2 jobs that push our incomes into the highest tax brackets. Other than loaning money to myself to pay for rental property, are there any other uses for those loan funds? What are the issues on the back end for repayment?
Right, dealing with a
Popular
loan.
question. We see
Yep.
that come around a lot.
Yep.
Yeah.
I'm receiving installment payments on a private money loan from my borrower. Are these payments listed as income even though the entire principal balance and interest haven't been paid yet? We're talking about installment payments, right? There's components of that payment. You get one check, but there's kind of 2 or 3 different components there, right? How do you show this on a tax return? I think they're in the right place for that one.
Yep, exactly. Sounds taxy to me. I have a C Corp and 2 LLCs. Can you clarify the tax allowance on Augusta meetings, please? Also known as 280A, we refer to it
Yep.
as such quite a bit. I believe I was informed that I can deduct up to 1,000 per month on these monthly meetings when held. Is this still the case for 2024 and 2025? We're going to clarify that.
Certainly go over that. Yep. Are the paid fees for business essentials? We have I think it's called the business essentials package, and the living trust. A couple products and services here at Anderson. So I got a couple of these Anderson products and services. Are they deductible as startup costs or operating costs? Great question.
What strategies should I set to invest in AI or energy stocks?
Nice. Good. Oh, and that's number 10. Excellent. So we're going to be diving into the detail here in just a moment, guys. Make sure you tune in to Toby and Clint's YouTube pages. Toby, of course, tax attorney, focusing more on the tax side of things. Clint, more on the asset protection. Of course, there's just a ton of crossover there, right? Blended lines there, but tons of great content on there. Check those out. I always say this, but I really especially like Toby's industry interviews with people from successful people, various captains of industry, I guess is one term. People successful in their various industries. It's great information. Just real, practical, and tangible, and applicable information. Oh, and there's Toby's page. We'll get to that in just a second. All right, the rest of the questions here. A C corporation owns a disregarded LLC, which in turn owns real estate. The real estate is sold for capital gains that is incurred by the C corp. A little different structure there. Is this the best way to be structured? We'll definitely discuss that.
Does the SALT, and that's the state and local tax deduction of 40,000 apply to a joint tax return?
Got an increased limit there. How does the new PTET pass-through entity tax, right? We have pass-through entities, S corps, and partnerships. Those are our pass-through entities. How does this new PTET, the PTET pass-through entity tax, SALT, the state and local tax? We talk in acronyms, guys. If we talk in acronyms and tax code, we'll just talk numbers and acronyms all day, and we'll know what we're talking about. How does this new pass-through entity tax, state and local tax deduction workaround policy work for high tax states like California? Great question. Are certain entities included, like SSTBs, specialized service trader businesses? Yeah, lots of acronyms, guys. So we'll definitely be going over that. That's kind of a kind of a confusing area. We're going to drill down on that. And there's going to be some changes there too. And finally,
yeah,
another good one.
it's going to be a day of definitions today.
Right. Yeah.
How might the research and development, notice I didn't put R&D.
R&D, right?
Tax credit, as amended by the big beautiful bill.
The OBBA.
Right, exactly. Help me as a small business owner. We're going to dive into that one. That is our final one.
Yeah, and here's Toby's page. Right. Tune into the YouTube pages, guys. As you can see, I'm subscribed. Are you?
Crazy amounts of videos and subscribers.
Great content there. And yeah, we got events. Scan the QR code. More information. If you want more information on any of these upcoming events, definitely let us know. Tax and Asset Protection Workshop. This is the one in September, right?
That is correct. This is the weekend one here, September 6th. That's going to be just the video one.
No, this is the video one.
Yeah, yeah.
Okay,
on
gotcha.
the 6th will be the video. And then the live here in Vegas tap event will be the September 11th through the 13th. That's Thursday, Friday, Saturday. Again, the one that Barley and I will certainly be in attendance at, and anxious to see you guys. And looking forward to
Excellent.
it.
So you got the virtual video version, or you can show up live. Of course,
That's
we
correct.
want you to show up live, but if you can't,
You just can't beat all the give and take that happens at these events. It's
right?
a really
Yeah,
great
that's true.
experience.
I totally agree. Plus, mid-September is not a bad time to come to Vegas. QR code. You can set up a strategy session right now, guys, if you need to. Again, kind of order of operations, submit written questions to the Platinum portal. You can go to the Platinum Knowledge Room and talk to a CPA or a tax attorney. Not quite yet anymore. 5 hours a day till 2 p.m. Pacific is when that closes. Or you can set up a one-on-one call with a CPA or tax advisor. Let us know, scan that code, and we can get that set up. Should we hop right in?
Let's do it.
All right, let's talk tax questions. This is a great question. I love that we're starting off with this one because we've had some recent changes in this area. Plus, for all of you business owners, a solo 401k, you hear about this a lot, right? This is one of these massive, massive contribution limits. Individual retirement arrangement, we get maybe 7,000 or so, depending on the age. Solo 401k, 10x that, 70,000 or more every year, right? That we can contribute.
Correct.
Each spouse and taxpayer. So if you're looking to max out tax-free savings, this might be the one of the first things we look at. So what's the maximum that can be contributed to a solo 401k as the employee and employer of my own business? What do I need to do to handle payroll for myself? So let's talk about the limits first, the contribution limits.
So of course, like everything, it's a good thing, but it's got limits. We're going to take away just the concept of the Roth here and just in general look at the 401k because it's the same.
Yep.
As far as overall limit, 70,000 if we're under 50.
Mhm.
Okay. And there's going to be an employer contribution as well as the employee contribution. So employee gets to put in 23,500. These numbers adjust basically every year or every other year. So employee can put in 23,500. The balance, which would be 46,500, could be put in by the employer. Now, there might be some other limitations on the employer. We'll get to that here in a second. But those are kind of the limits you would have there. Now, if we're 50 to 59, then we can put a little bit more, a little catch up going on, another $7,500 for a total of 31,000 as the employee. And again, it'd be still 46,500 for the employer. And then lastly, new with the big, beautiful bill, I'm going to say that one right, they have this unique category if you're 60 to 63. There you can actually put in an additional 11,250. That is an additional amount to the regular plan amount of 23,500 for the employer. That boosts us all the way up to 34,750. And again, still the employer is putting in 46,500. Now, when we talk about the employer component, there are some limits there, 25%. What do we got going on there?
Yeah, so it's a percentage limit on the employer side, a dollar limit on the employee side. Yeah, so essentially, whatever you pay yourself in compensation, it's roughly going to be 20% of that. There's a slight adjustment for payroll taxes, but essentially, if you pay yourself 100,000, we can assume roughly 25% of that's going to be eligible to be contributed over to your solo 401k.
Yeah, so we just look for your W-2. What was your compensation? We take that times 0.25. That's the amount the employer can, but with a total maximum amount of those contributions of, again, 70,000, total 77,500 or 81,250, depending on where we fall.
Depending on your age. Right. And what Elliot was saying is that that top limit's not going to change, right? Or I'm sorry, the top number, the overall contribution limit will stay the same. It changes obviously with our age, but that's the part we'll look to adjust. So we get to max out employee dollar amount. Then we just look to write out the balance as the employer. Now you got to write yourself a pretty decent sized W-2 paycheck to max this out. But you don't have to max it out.
No,
you don't have to contribute to the max, right? You can contribute as much or as little as you want. But when we're talking about north of 80,000 a year that we can contribute to a solo 401k to grow tax-free, that's when we definitely want to pay attention to that.
And we know if we're going with, let's say it's an S corporation, we know we can put in 25% of whatever the earned income was. But we just look to that employer limit, which we now know is 46,500. We just divide that by 0.25. And what we see is that as long as you're getting paid compensation of 186,000, that's where you're going to be able to maximize both the employee and employer portion, and hit the
max
amount.
Yeah, absolutely. And then so as far as how should we address the Roth component of this?
There it does get interesting, and this is a different story in 2025 than it was in previous years. in previous years, what you would do is your employer wouldn't contribute to a Roth. Okay, and just to back up, you have the traditional portion, which is a deferment or a deduction, if you will, to the employee or the employer, to be, whichever is putting in. Then you'd have that Roth component where we wouldn't get a deduction. And the reason why traditional contributions, they grow and you're not taxed on them, but you get taxed when you later take them out at retirement. Not so with the Roth component. You don't get a deduction going in, but it grows tax free. And then when you take out later on in retirement, you don't have to pay any tax. And so that's the real play here. And specifically, our question's asking about the Roth component. Well, before, back in 2022 or so, or before that, we were not able to, our employer could not contribute into that Roth component. But they changed that, allowed it. Took us a while to hear from them about how they wanted us to really do it. But basically, all that's happening is if the employer puts in a portion, let's say $10,000 into it, let's say Barley's making $100,000 on his S corporation, he wants his employer to max out that 20. We know it's going to be 25 is the max. Whatever amount it was, let's just say it was 10,000 going in. We add it to his payroll that the employer is putting in that $10,000. We add to his paycheck, his compensation, $10,000. Barley shows it as taxable income, that 10,000. So he has to pay more tax on that on his personal return as 1040. But the business, it doesn't get it doesn't get a deduction necessarily just for the contribution to the Roth, but it does get a deduction because that extra 10,000 is part of his salary. So the business gets a deduction in the sense that I paid a paycheck for an extra 10,000 to Barley. Barley pays tax on it. So we don't offend any of the rules. This was all, in that sense, it was after tax. The money goes into the plan, grows tax free, but we will still have those overall limits up to 25% of compensation for the employer to put in. We have the overall limits of how much that we walk through of how much the employee can put in, and then it's always countered by how much the employer can put in.
So a lot there, obviously, right? A lot to think about there, especially with the new Roth component. Now, remember, we used to do these Roth conversions, right? We'd have a traditional IRA, we would convert it to a Roth to grow tax-free. That'd be a taxable event. But now we have an option to kind of start chipping away at adding to the Roth amount via our paycheck. And yeah, the deduction part of that gets pretty exciting, right? Who's taking the deduction? Which part of it's tax deduction? Which part of it's not? Speaking of that, let's skip right to the second part of this question.
Yeah. We get to the payroll.
Because this is where it happens.
Yes, absolutely.
This is where all of these little entries and balancing things have to happen.
It's going to happen on the paycheck. And when asked about how, what's the best way to do it is, as you said, don't do it. I would never do payroll myself. I used to for a company. I will never go back to that. Never say never, but I'm saying never. It's tough. There are certain people who are wired to do that. And they all work for, payroll companies like Gusto or whatever it is, exactly. They sucked them all up and they hired everybody who knows how to do it.
Right, yes, no one left out here.
I wouldn't do it for yourself, but if so inclined, there are some key elements to it. We have some reporting requirements. We got a federal form the 990?
941 is our annual, 940 our quarterly.
Yeah. Got to do those every quarter. The quarterly is going to cover how much is your federal income tax, all the Social Security, Medicaid, all of that.
Taxes, yep.
Then we got that one at the end of the year. That's going to be your FUTA, federal unemployment tax. And so these reporting requirements, if you don't know what you're doing, again, this is where you probably want a professional do it. It's worth it. If nothing else, just look at what they do. If you feel so energized that you want to take this on, well, pay someone to do it for a while and then copy them.
Right. That's a great suggestion.
But it's probably not the best. I would still not do it myself. But
I like applying that to bookkeeping. I like that with bookkeeping maybe a little better. Yeah.
But that's what you need to do. Those are some components. We got that quarterly and annual reporting, which is very important. They're going to track you down. They're going to give you some grief, some pain if you don't get those in. So that's part of it. Certainly, you got to make these checks on a regular basis. Make sure the real withholding. I can tell you from having done it, that federal withholding has to get turned into the government, so they get their money. You actually can get personally held liable for that, even though you are an officer of a company. So there's lots of incentive not to do this yourself. But that is a unique place where it's one of the few places as an officer you can be tagged with a lawsuit if you mess this up because you're doing withholdings on behalf of employees.
Even if you're the only employee, it doesn't matter. You can still get in trouble for that. Now, just FYI, Gusto, places like that, you can look for kind of a scaled down payroll service. You don't have to do every 2 weeks, right? You can extend that out a little bit to probably save some money there.
Great
Less
point.
less bells and whistles. You know, ADP is going to charge you the full price for every 2 week payroll or whatever. But you can get away with doing that less frequently.
Yeah, a lot of clients do it quarterly, or
Yep.
we get as tax advisors, we get hit up all the time with, well, what should I do by the end of the year? To we'll look at how much you paid in. Maybe sometimes we say, hey, you don't need to do a fourth quarter payment. You've done
Right.
enough wage. Other times we say, hey, we got to bounce it up a little bit more. That's
Mhm.
fine. We can do that.
Mhm.
So there is a lot of tax planning in this potentially. However, going to recommend you have someone else do it if possible.
Yeah, payroll and bookkeeping, it's just one of those things. You know why I like it too is because that really is the foundation of our operations. It gives us so much information, and if you don't have to think about it, and you got good books and records, it's going to tremendously help you just view your business through a lens of what's profitable and what's working and what's not. Very, very important. Any questions we want to go over on that one?
No, I think we're
Doing
good
good.
there.
Oh yeah, we got the whole team in the background.
Yeah,
Rachel's in there now. Was she in there
Yeah.
before? Yeah.
tearing
You
it
guys are in
apart.
good hands there in the Q&A, so keep them busy. You have some really capable professionals in the chat, so or in the Q&A. Ask
No
them questions.
question.
All right, let's move on here. Talk about a lot. We handle everything on there. I mean, we could go more into the weeds on the payroll, 401k stuff, guys. If you, as usual, you guys have all heard me say this before. If this applies to your specific situation, let us know. We can drill into your specific situation a lot more. Send us a Platinum Portal question. Set up a tax consult, whatever the case may be.
And as Troy pointed out into the webinar chat, we do have a new payroll partner, New Tech, and he put the conveniently the link on there. Thank you, Troy.
Oh, good. Okay, they're doing
Yeah.
payroll now too. Also banking stuff, I think too,
Yeah.
right? Yep.
Open. We're telling them they
Right.
are.
All right. Let's next question. Let's go.
Yeah, is this our loan one? Yeah,
Yeah.
here we're going to get into some loans, the next couple. We do a lot with loans between companies and things like that, and shareholders and back and forth. So thought we'd bring some clarity to the issue.
Mhm.
I want to loan cash from my business to myself since my spouse and I have regular W-2 jobs that push our incomes into the highest bracket.
Mhm.
So the idea here is, well, I don't want another payroll from my company, or I don't want a dividend because we're already in the highest bracket. What if we just take the money out as a loan? Other than loaning money to myself to pay for rental property, are there other uses for the loan funds? What are the issues on the back end for repayment? So a lot of details going on there, and we'll tear that apart here.
Mhm.
I think first of all, a lot of you are familiar with the loans from shareholders. That's where a shareholder lends to a C corporation, let's say, and we have a certain arrangement that we set up. This is a little bit different. This is you have money, cash in your business, and you want to loan it out. Now I'm thinking probably corporation here, C or S corporation. And the unique thing here that the IRS really gets, all nervous about is you're taking money out of a corporation, probably from profits of some nature. That's why it's there, and you're giving it to yourself without paying any tax on it because it's a loan. Well, the IRS, as you can imagine, gets kind of bustly about that. And so we got to make sure we go with formality. We got to have this written out. You need to have some kind of written document for what this loan agreement is. You need to have regular payments. And indeed, those payments have to have an interest component. How much? We usually go with applicable federal rate.
Yep.
We can find that. We go with a blended rate typically. That comes out every July each year. This year for July 2025, I believe, is 4.22%. So that's going to be imputed, added on to that amount, is usually what happens if there is no payment going on. But as I stressed just a moment ago, this is very different than a loan you may make to your C corporation. This is you as an individual taking money out of the C corporation. We don't get that lax, of whether or not a payment's made or anything like that, because this is money coming to you. You must make a payment. You must have a payment schedule, let's say every month, amounts being paid back on that loan. Again, with that interest rate of 4.22 for 2025, that blended rate. We got to make that payment. Otherwise, this is nothing more than hidden compensation to you, and the IRS will do so and
They'll
change.
make it a dividend or a
Yes, sir.
W-2
Exactly right. And we get
Yeah.
right back to where you were trying to avoid
Right.
because you're in the highest bracket. So that's fine. Take the loan. That's okay. And it's going to be you personally. And, again, got to pay that interest back in.
Mhm.
Now, when it does that, when you pay the interest instantly, that part is, before we get to that part of it, what the uses are for the loan funds. Now, you take that on personally, you can probably do whatever you want with it. Certainly a business venture, put it into stocks or something like that, that's fine. But there's no really condition, but I would suggest not doing it something for your personal use. While there's really nothing out there that says you can't, but it might give that shade of inference that maybe this was just compensation you took out, you use it to go, on vacation or something like that. And if you're not really careful on the repayment, I think there you're going to really run into some problems with the IRS under audit. So I would suggest keep it for business purposes, but there's nothing in the code that says it has to be.
Mhm, mhm.
Any thoughts on that?
No, I mean, I like the strategy. You're lending, borrowing is not income, paying it back is not an expense. You're certainly right. So I guess maybe I would just suggest make sure you have a pretty clear idea of what you want with the funds and how, when you could pay it back. That'll allow you to structure your note in a really airtight way.
Mhm.
We're borrowing this much, we're going to pay it back over this timeline. Yeah, I don't know what else to add to that other than I don't love it, but it's a good strategy for higher income people.
And especially when we're in the era of maybe higher rates,
Right. Why borrow from anyone else?
a lot of debate on that one. Are we actually in an era of higher rates? Well, maybe compared to where we were 10 years ago, but historically, really the rates aren't that bad.
That's good.
We're actually quite spoiled. I know nobody likes to hear that, but they're
Right.
just not that bad.
Sure, you can borrow money at 5% or
All
something.
right. I was just listening to somebody from the Fed Reserve, and they were talking about how their parents had to take an 18% note
Right.
to get their house back in the 80s and the 70s.
Right.
So, it's been worse. But maybe you'd want to wait. I think probably this is a better plan when we do have lower interest rates because you're not paying as much in interest. But if it all keeps you out of that highest bracket, and just to your point, you have a good use for how you've planned on how you're going to use these funds. You have a good payment strategy to put it back in. I think that's just fine.
Mhm.
But just make sure you've documented everything. You got a
Mhm.
true note out there, in writing, payment schedule, and we're making the schedule, and it has interest.
Issues on the back end, you are going to borrow money and owe interest to the corporation. The corporation will report interest income. Uh, just FYI, that's about the only kind of taxable repercussion there.
Yeah. Just the biggest issue is that you do make payments.
Mhm.
So many people say,
Yeah.
well, it's just between me and my business. Well,
Who's going to know?
yeah,
Right.
well, they're gonna know.
Yeah.
And so yeah, you want to make sure you do all the compliance. It could be that you have to send out, some forms for how much. We do a lot with 1099 INTs and things like that.
Right.
So there could be some reporting like that as well.
Right, that's a great point. We got, obviously, as most of you know, the forms library plus the document review process. Those two combos right there, those two things combined right there is that's a great service. Pull a form from our library, fill it out, and then have one of the attorneys let you know if you filled it out right.
Yeah.
Take advantage of that.
But you just want to be really careful of this image that you're an employee or an officer of your own C corp and you're taking money out and you're not declaring it as income. That's what the IRS is very suspicious of.
Right.
And so having that payment schedule with respectable interest rates and following through on it is going to be critical.
Any questions want to go over?
I think that's it.
All righty. Okay. I am receiving installment payments, that's 6252, on a private money loan from my borrower. Are these payments listed as income even though the entire principal balance and interest haven't been paid back yet? How do you show this on a tax return?
It's a great question.
Yeah.
It's a nice follow-up from, we're getting into the area of loans here. First of all, when you're lending out, now you're getting paid back. Lending itself, in and of itself, is not a taxable event. So if Barley lends me $100,000, bad idea maybe, but it's not income to me that I take it, nor is it a deduction to
Right.
Barley that he did so until it's considered a bad debt. Maybe
Right.
and I don't pay him back. Maybe
We just have a note, just
Yeah.
have some sort of instrument to record the loan.
Exactly. And, but of course there's interest on this,
Yeah.
and that's going to be income to him, certainly, just like we saw on the previous question. So, even though the entire amount, if I start paying them back, regular payments, there's going to be a component of interest in those payments. We see that on a mortgage or anything like that. We have these schedules, that show your payments, your amortization tables on your repayment on loans and things like that. It's no different here. We'd want to have that going on. And a portion of each payment is going to be repayment of balance. So likewise, that's not income to him. He's just getting his money back, nor is it a deduction to me because I'm just paying back what I owe him. The interest component, that's something else. That is going to be income to him. Now, I guess whether or not how I handle things will depend on how I spent that money. It's whether or not it's a deduction to me. If I went out and took the funds and spent it, that's a whole different consideration. If I use it for some worthy business project, I might have some deductions going on there. But my repayment to him is certainly not a tax event, with the exception of the interest. So that's one thing and even though the whole amount hasn't been paid back, you're just going to take a small portion. Typically, you take 10% annually or something like that. You divide it up over 12 months. You take your little bit of interest payment on each one. And how are we going to show it on the tax return? If you're getting this interest income, where we put that?
Yeah, so there's an installment sale I think it's 6252. I wrote it down somewhere. But yeah, it's an installment sale request form or something like that. And you're exactly right. That even though the entire principal and interest hasn't been paid back yet, that's the benefit. That's why we do these, right? This will typically benefit the buyer or the seller, but that's going to be one of the benefits in some of the cases. You don't have to report that income in full, right? You report it as you receive it, so that can be very, very beneficial. So add in the interest rate considerations there, and there can be a lot of upside here. Yeah, how do we show that on a tax return? You have an installment sale form. You have to do this in the year of the sale. Fill out installment. I mean, I don't know many other restrictions on that form.
And then also, and this don't get, you don't want to mix this up with installment payments where you sold something. It's a little bit different there. That can have a component of gain.
Oh, that's what I'm talking about. I'm
Yeah.
sorry. Thank you, Elliot. Yeah, no, that's for selling, not receiving payments. You're
But
absolutely
we're
right.
still going to have components here. We have
Right.
the interest and the principal being paid back. We might put the interest here on a Schedule B. We do that often. We see a lot of interest. If you're receiving the interest, we could put it there. But Barley's right. It's still the same concept of an installment in that it's just not going to have a gain component because we're just getting interest and principal back. Yeah. So that's kind of both sides of what we look at for these various notes. Again, documentation is so critical.
Right.
Make sure we're
Very
doing that.
fact intensive, that the loan and borrowing portion.
Yeah. Now, just again, where we show it on the return, we mentioned Schedule B's, and boy, that's where a lot of interest. There is like if you're a bank and this is really your number one business, this is what I do. This is the only thing I do. I lend all day long. There might be, you might be putting it in some different places. It could maybe conceivably be a Schedule C type business if that's really what you do, your core business. But that's few and very rare to see that. So I think we'd be looking at Schedule B.
Probably a highly regulated industry.
Yes, you got to watch out for some.
Yeah.
Certainly, usury rates. We talked about those. Which they're quite steep,
Yeah, we're in Nevada. You can do whatever the heck you want here.
Yeah. It's just
If somebody will pay the rate, you can charge it.
Yeah. The user
And they
rates are a
do.
little bit different.
Right.
Lose fingers.
Any questions on that? Moving on.
I think we're ready to go.
Excellent. All right. I have a C Corp and 2 LLCs, limited liability companies. Can you clarify the tax allowance on Augusta meetings, please? Augusta, the Augusta Rule 280A meetings. I believe I was informed that I can deduct up to $1,000 per month for monthly meetings when held. Is this still the case for 2024 and 2025? Great question. So what we're talking about, the 280A Augusta Rule, this is low-hanging fruit. Easy money, guys, for pulling cash out of your corporation tax-free. Remember the win-win here. It's a legitimate business deduction to your corporation, corporate meeting expense or something like that on the profit and loss, right? Legitimate business deduction, lowering taxable income at the business. But this, when it hits your pocket, it's like a reimbursement. It's technically rental income, but we just don't have to report it if we meet the test, if we meet the requirements, right?
We certainly don't have to pay tax on it.
Certainly don't have to pay tax on it.
But just stepping back, this 280A, we usually go, because that's the code section. This is found under, it's also known as the Augusta Rule because it comes out of a case from down in Augusta. But this has nothing to do with C Corps, nothing to do with LLCs or anything like this. This is a provision to you as an individual. Barley can do it, I can do it. Troy, anybody out there can do this for their personal residence. You can rent it out up to 14 days a calendar year. Can't go over that. But the income you receive is tax-free. Now, if you do happen to rent it out for 15 days, well, then all of it becomes taxable, even that initial 14 days. That's why we so stress, if you're going to do this, that keep your rental under 14 days or less. Now, where the businesses come in, let's just pretend that if I was going to go to Barley's place and I said, well, hey, here's $1,000, I'm going to be staying at your place. Well, he's going to learn in like 2 hours, if less. He doesn't want me there. All right. So better than that, what he can do is he can have his own corporation rent his home out, have a meeting in his place, in his home. That's where you hear about maybe it's $1,000 or something like that. That's where we start bringing in corporations and businesses. In this case, we have the C corporation. We would typically do it on the C corporation. These LLCs, we don't know how they're taxed. We've talked often about that. It depends how they're taxed, but it's going to be your corporations, your S corporations or C corporations that generally take advantage of this because they're required to have meetings. Okay. So they can have a meeting in your home, pays you a reasonable amount. What's reasonable? Well, we got to do some background. How do we determine reasonable on one of these?
Right, and we got a whole kit on this and videos on it as well. 3 local quotes, right? Go down to the local hotel with a conference room and say, "Hey, I want to rent your conference room for a day." Audio visual, right? How much is that going to be? Get it on a kind of an estimate or an invoice or an email with some sort of, corporate letterhead on it, make it look official. Get 3 of those, take the average. That's how much you can charge your corporation. You're going to charge rent to your corporation. And again, just like Elliot said, as long as you do this less than 14 days, you don't have to pay tax on the income. So the Augusta rule, the Masters golf tournament down in Georgia, right? This tiny town of Augusta, hundreds of thousands of people descend on this tiny town. They were essentially like, "Hey, we're being forced out of here. I'm not in the business of renting my house. I'm being kicked out of town. I'm going to rent my house out to people that they're going to pay me these exorbitant prices. And then I'm going to come back when the whole mess has been cleaned up." And the IRS is like, "All right, you're not in the business of renting your house. You're kind of being forced to do this. We're going to say, as long as you do this less than 2 months or 2 weeks, less than 14 days, you don't have to pay tax on the income." So that's where we're just applying that to our situation here. Again, the quotes, you get 3 local quotes. Local is important, right? If you live in the Midwest, you don't get quotes from the San Francisco Bay Area or something like that. Have to be local, reasonable quotes. Just for a regular sized conference room, 8 to 10 people, whatever, just keep it reasonable. Audio visual for the day, get 3 of those quotes, take the average. Then essentially, yeah, your corporation is just going to pay you rent to rent your house, rent your living room and kitchen. You're just going to hold a board meeting, whatever you do. Again, as long as you do that less than 14 times, you don't have to pay tax on that income, but still a tax deduction to the business.
And just, because we get asked this a lot, and it is confusing in the code, but it's 14 days or less. So you can do it 14. We mentioned some other LLCs. If those were corporations as well, we get asked a lot, well, can I do 14 on each one of them, each of my corporations? No, it's a total of 14 because that's you, the individual, renting out your home. So
Great
we could do 7 and 7,
Yeah.
2 and 12, 0
Yeah.
and 14, any combination of 14. We just
Yeah.
can't go over
The
14.
limit is at the personal level.
Yeah.
Yeah, you can't. So if you're already renting a room in your house to somebody, you can't take advantage of the 280A, right? Generally speaking, just to clarify that, the limitation is at the individual level. Exactly. Yep.
So just again, sweeping up a little bit here. So it's not that there's anything that's magical about 1,000. We just throw that out there because a lot of places we hear from our clients, well, they're getting quotes for about 1,000. That's why we use it. It's certainly different depending on where you live. San Francisco is going to be a very different price than, let's say, Missouri, or small towns or something like that. You're going to see a great variety, but typically we see anywhere from 750 to 1,500. We usually just go with 1,000.
Yep.
That's what they're referring to. It's not a matter of 2024 or 2025. It's just whatever the quotes are for that year.
Good for estimate purposes. If you're trying to how much can I pull out of my corporation? Throw $1,000 a meeting is a great place to start for an estimate. Yeah.
Could be lower, but that's not. That's on the low end of what we've seen out there.
Yeah. Excellent.
So yeah, great question. Hope that brings some clarity.
And yes, this is still available for 24, 25. This part of the code didn't really change. We can take advantage of this every single year. That's going to be a point for a lot of these guys. Wash, rinse, repeat. We want to put these on autopilot. Reimbursing for your home office, your 280A meetings. Set this up. Set it and forget it, right?
Yeah.
That's the idea here. Set it and forget it. You can get these deductions.
Just make sure we're making the payments because that's how you get the deduction. I would say this, that there's sometimes we talk to people. I know, like back in 17, I'd have some conversation. We used to, some kind of consult with a client, go over this. They get busy, COVID happened, all these things. And then they come back in 22, 23. Well, we never really started that. And that's fine. Hey, today's a perfect time to start then. But just imagine over 4 years, if you were doing this, how much now we're talking about, how much tax savings in cash. I don't know anybody who doesn't want 14,000 of cash tax-free in their pocket. If you don't want it, we'll be happy to take it. I'll split it with Barbara.
Well, we can talk about gifts taxes. Yeah, tax-free.
Yeah, exactly. Give it to your favorite tax advisors. These guys. It adds up, and so you really want to take advantage. You mentioned it's the low hanging fruit. I mean, this is fruit. It's not even hanging anymore. It's just
Yeah,
on the ground.
right.
Okay,
Pick
it's
it up and
so
eat it.
easy.
Yeah.
Yeah.
And did you mention cash has to change hands?
Oh, just briefly hit that again. Yeah.
I was gonna say,
Yeah. Can't say that
just say
enough.
it again. Just
Mhm.
say it again,
Mhm.
verbatim. Yeah. So to substantiate the deduction, we get the $14,000 check in our pocket that we don't have to pay taxes on. Yay! How do we substantiate that? The corporation has to actually write us a check to take that, and then how do we substantiate that? I have to turn in 3 invoices and take an average quote and come up with some sort of rental agreement for my corporation, right? We've got to trace this all the way back. We have to follow those steps. But again, you're going to be doing the exact same thing next year, right?
Mhm.
It'll just put it on autopilot, put it on repeat, and cash hands to change hands.
And because we are doing meeting minutes for a corporation, that's why it's renting typically. You do want to make sure you have those meeting minutes written up as well.
Mhm.
If you're one of our CAP program clients, that's our company assistance program. All you have to do is go in and log in to our website, get into your Platinum portal. There it says corporate meetings. Just type in the information. What entity? Well, my C corp. Where at? It was at 123 Main Street. My home address.
Mhm.
What was talked about in the meeting. Throw that all in there, hit send online, just hit enter. It comes on to us digitally. We're going to fill out your meeting minutes for you for free.
Mhm.
So
Now you're in compliance with your
yeah,
board meetings.
I don't
Big
think
deal.
we could make this any less stressful.
Right. Yeah. Yeah. This is a
It's
great example of the easy money part of it.
yeah.
Hmm. Yeah, absolutely. Anything else on there? Yeah, let us know if you have questions on that one, guys. Certainly. Now, this doesn't have to be monthly. I mean, if you had 14 days left in the year, would you hold 14 meetings? I don't know. That might be pushing it a
I
little
don't know how
bit.
many we go to a month. I mean, we have
Yeah,
all
right.
kinds.
That's actually true. We do several a day. So, a little bit of reasonableness there, but it doesn't have to be monthly, right? You get 14 meetings a year. That's it. You use it however you want. Yep. All right.
Go.
Did we mention
This guy.
Did we mention this guy? Did we mention that you should subscribe? Did we mention that we're up to 1,000 videos?
My gosh.
Did we mention that we're also 500,000 subscribers? Booyah! Almost 1 million between the three of them. Excellent. Make sure you tune into the YouTube channel, guys, as most of you know. But for anyone that hasn't been there, just go there right now. There's just so many cool different topics. All sorts of entrepreneurs out there doing the thing, and listen to what they're talking about. Great advice. And of course, scan the QR code right now. We can set up a strategy session. If you have specific, you want us to crunch some numbers, specific guidance, anything like that, let us know. We can set up a call to do that. And of course, we want you to show up at the live event here. I'll be there Saturday. Can't wait to meet you guys. Scan this code. Come on down to Las Vegas. Uh, the Durango really is nice. It's beautiful, beautiful. That's a local family too. That's Station
Yeah,
Casinos or something like
I
that.
believe so.
Yeah, they've been around a long time.
Hmm.
So look forward to see you guys then. Back to the taxes.
Yes.
All right, what do we got?
Are the paid fees for business essentials and living trusts deductible as startup costs or operating costs?
Mm,
We get this a lot.
yeah.
And this question is a great question. And so I thought it was time we'd answered this maybe a long time ago. It's time to bring this kind of thing up. These type of things, business essentials, those are the packages that you're using to help operate your business. Okay, that's why we call them essential.
Mhm.
And that is a business expense. Yeah, that's deductible. Okay, now is it a startup cost or operating cost? Well, it just depends. If you paid for it prior to starting up and to actually starting your business, probably going to put it in the startup column towards that. If it was after the fact, then it's going to be an operating and probably deduct the whole thing right away that year.
Yep.
That gets into a little complexity. That's more how the tax preparer is going to have to present it per the rules for startup costs and things of that nature. But it's going to be really a factor of were you already in business, already up and running when you incurred the cost as to whether it's going to be one or the other. The only difference between them, startup costs you may have to amortize. Okay, that's a possibility on startup costs because we can deduct 5,000 typically right away.
Right.
The rest would be amortized, generally speaking.
Yep.
Operating costs, we don't have that problem. You deduct immediately. And again, that's for your business essentials. And indeed, just about anything you pay with Anderson for, we're a business service.
Mhm.
It's probably going to be deductible. With
But
one exception. And what's that?
with one exception. Yeah, our living trust. So that's the living trust. You'll hear us say this a lot too. It's not a tax. There's no tax repercussion there, right? Well, I set up a living trust. How's that going to affect my taxes? Well, until you pass it's not really going to affect your taxes at all. And this is for personal wealth building, personal legacy planning, personal wealth planning, therefore a personal expense.
Yeah, and so we typically don't deduct that, the living trust expense. So it'd be neither startup nor operating.
But like Elliot said, these are a couple services and products offered here at Anderson. Business Essentials package, living trusts. The benefit, if we do your taxes here, any dollar you pay us, we're going to put somewhere. I mean, living trust, that may not be deductible, right? Likely not deductible for most of us. But your platinum subscription fees, all your entity fees, we'll do all of that allocation if we're doing your tax prep. Just FYI, if you want to skip that part of the bookkeeping, any dollars you've paid for us, if we're doing your tax prep, we'll allocate all that stuff for you and show you the breakdown of it.
Yeah, and I don't think we've gone over one thing today that's a personal expense. I mean, just about everything we advise on, the vast majority of it is business related.
And isn't that part of the whole point of why you guys are here, right? We want to turn, I pay all my utilities and cell phone and internet bill at the house. How do we turn part of that, or I mean, it already is in essence a business, partially a business expense, right? How do we get a deduction for it?
How do we get it to cross the line where it actually is, and we get that deduction? That's exactly why we're here.
Legitimate business expense to the business and a tax-free reimbursement to you. Yeah, absolutely. Yeah, that recharacterization of those expenses. Absolutely. Great question. Right. Oh, this is a good one too. What strategies should I invest? What strategies should I set up to invest in AI, artificial intelligence, and energy stocks? Well, Ellie and I, of course, talked about these before. What I did with this question, I just kind of took AI and energy out of there. And what structure do we advise to investing and trading stocks? Now, I don't want to totally disregard that. Of course, we're talking about energy. You might be talking about oil and gas. We could maybe structure that a certain way. If you have your own business, closely held stock in some sort of business, that might be treated a certain way. But what we're assuming here, you're buying and selling equities and stock in AI companies and energy companies.
Yes.
Yeah. So what do we recommend?
Well, we got a couple different paths we can take. If it's something that you're not really an active trader, this is not what you do all day long. You're not trading stocks. You're not following the market. You just made an investment, and 3 years from now, you're like, oh yeah, I did make that investment. We're probably just going to put that in a Wyoming LLC, what we call safe assets. You often hear Clint and those speaking on structure about, they talk a lot about that. That's all just those are assets that don't do anything. They're not going to get you sued. The fact that you invested in stock A, B, or C isn't going to get you sued. Until you start giving away secrets, trading secrets or something like that.
Yeah, but no one's going to trip over your brokerage account and sue you.
Right, exactly. So
safe asset.
Just put in that LLC, you're good to go. That typically has no operations that it's going to get that box, that Wyoming LLC sued. So we're good. But what if we are doing a little more active trading? Then maybe it's time to look for some tax advantages. And we do have a trading partnership. We often talk about setting up a partnership, put the brokerage account into that. It's no longer owned by you, but it's now owned by the partnership. Why do we do that? Barley invests in something, he makes $100 gain. Right now, all of it's going to hit his 1040, $100 tax on his 1040. The minute we put it into that partnership, though, and we started there, and let's say 10% owned by a C corporation, 90 by him, immediately that $100 got split. $10 to the C corp, 90 to him. So we've already saved the tax on $10 off of his 1040.
Right. Reduced my taxable income.
And we all know, oh, hey, Elliot, you still have the $10 tax at 21% on that C corp. That's right. But what do we have in a C corp to help us out there?
Reimbursements, tax-free.
Totally. And didn't we just talk about one?
Home office, 280A.
280A, Augusta rule, all of that. Maybe medical reimbursement. What do we got going on with medical?
Yes, unique to a C corp. We can reimburse you plus spouse plus dependents for 100% of your out-of-pocket medical.
Absolutely.
Qualified medical.
He can use all those things to get that $10 out of that C corporation back to him tax-free. So he's got $10 tax-free in his pocket, didn't have to pay tax on his 1040 for it, zeroed it out on the C corporation because these were all deductible reimbursements from the C corp. So that you can't beat. There's win-win. That is like win to the nth degree.
Yeah.
It is, it's a really great play. We always want to look at the numbers. Now, what if he had enough money coming into that C corporation as far as gains? It wasn't $10, maybe it was 10,000, or maybe it was 20,000, and he only had so much in the way of 280A or excuse me, only so much gain coming in. Let's say it was 20,000, but let's say he had expenses for 30. If he done his 280A, if he did his administrative office, if he did his medical, let's say those expenses are 30,000. So he has kind of a budget in his mind about how much he could take out at C corp. But he only had $10,000 of gain, let's say, or 20,000 maybe from his trading. Can we get any more than just the corporation's percentage ownership? Can we get any more income? And we can. Partnership has a very special payment that we can do.
B Corp.
See, well, the partnership has the payment, but it's a C corp that's going to earn it. It's a guaranteed payment.
Oh, you're talking about I thought you were talking about loan shareholder.
Yeah, well, to get more money in, earned income into our C corp. So can you walk through the
Oh, sure,
guaranteed
yeah,
payment?
yeah. Right. So the first part we're talking about there is the K1 split, right? Set up a partnership. I'm 90, C Corp is 10. So right there, that we're gonna have the K1 split, $90 to me, 10 to the C Corp. But then there's other ways we can get cash to the C Corp, like Ellie just mentioned, the guaranteed payment. This is unique to a partnership. It's called a guaranteed payment to a partner. It's to reimburse for services provided or capital provided. The unique part about this, that this is ordinary income to the C Corp. So now it has some earned income over there. That creates kind of some special advantages there, but also just gets more cash to the Corp.
Exactly.
Right.
So if we have that deficit, he has far more he can do as reimbursements than what is budgeted in the C corp. Well, we can get more in there as long as it's all reasonable. And you certainly want to have it written out what exactly those services are that the C corporation is going to provide. It could be marketing services, it could be bookkeeping, making sure the tax returns are done, any number of things. But the key is here is that this is a way he can shift significant amounts of money off of his return into the C corp and get it back tax free.
Yeah.
Or we just leave it all on his personal return, it just gets all taxed there.
Right. And so all we're proposing here is I either have I have some capital gains. I either have $100 capital gain income. It's either all going to hit my personal return, or we set up a trade structure. I have $90 capital gain hit my personal return and $10 in my pocket that I don't have to pay tax on. Right. Obviously, the more zeros we add to this, the more it's going to make sense. So it's certainly something we want to take a look at. Now, conversely, I know we got to kind of keep it moving a little bit, but let's say we have a killer year and a bunch of money in the C Corp. That's where we could go all the way back to our first slide and look at a solo 401k, have a qualified retirement plan sponsored by the corporation. Huge benefits to this. You're not likely going to have employees in your trade structure. If you have employees in another business you control, that will obviously affect this. But for those of you really killing it out there with the stocks, and I know there are some of you, right? You got a bunch of money in the C Corp. You can put yourself on payroll. That C Corp can be your, can reimburse your medical bills, your home office expenses, put you on payroll, qualified retirement plan. I mean, this is a win-win, certainly, for our closely held, family-held corporations.
And to bring it all back 360, we're doing so well. We got all these transactions going on. That will justify you getting that bookkeeping, and they'll handle your payroll for you.
Right, there you go. Yeah, that's right.
Which is deductible.
Once you're getting all the good capital gains from the AI and energy stocks, exactly. Great questions.
Yeah. So again, no activity, very limited activity. Just put it in a Wyoming safe LLC, safe assets. A little bit more activity. Think about that partnership. Of course, we want to talk this out. You want to have a consult so we can see the numbers make sense. If the money doesn't make sense, don't do it.
Right.
But these are things we certainly, hopefully that just explains how we make those decisions.
Yeah, that's a great, but you're going to have an extra tax return, some extra bookkeeping, 2 extra tax returns in the case of a trade structure. But if we can reimburse $20,000, $30,000 back in your pocket, we're going to twist your arm and make you do that. Yeah. All right, keep moving.
Keep moving.
C Corporation owns a disregarded LLC, which in turn owns real estate. The real estate is sold for capital gains taxes incurred by the C Corp. Is this the best way to be structured? Of course, here at Anderson, you've seen kind of 2 basic structures. One for long-term buy and hold, passive, typically long-term buy and hold real estate. Another for flipping properties through a C Corporation. We consider that inventory flips through the C Corporation. In this question, we kind of have a little bit of combination of both. So let's untangle that a little bit here.
No, you're exactly right. And so we can, that disregard, we can just forget about it. Pretend it doesn't exist because it doesn't as far as a tax perspective. So it's really the C Corp that owns the real estate for all intents and purposes. We're not going to have capital. We would never recommend ever putting appreciable real estate into a corporation, S or C. There's only one exception to that. That's when it's your primary residence. And maybe we may tell you to put it into an S corporation, but we're not dealing with that here. That's not at all in play here. So you're never going to do this. We're never going to recommend this situation unless you're going to flip. And if it was a flip, it's not capital gains.
Right.
It's ordinary income. I think you mentioned inventory.
Inventory.
It's exactly what it is. And because Barley's selling off some inventory, that's ordinary. It's not going to be capital gains treatment. So that's why I like these questions where maybe we get a couple different concepts confused a little bit. We'll see that in another one here in a little bit. So if it is a flip, that's the perfect place for it to be. You want it in a C
In the C
corporation.
corp, in a disregarded LLC, just like you have it.
Exactly.
Yep.
I wouldn't do anything different. Only question would be, do you want S or C? And that's another story. But either way, it's going to be in a corporation. Disregard, flip it, you're good. But it's just not going to be capital gains. If it is something that you're holding long term, as Barley pointed out, that's probably going to be a rental or something like that. We would never recommend putting that in a C corporation. So there, we would not have a C corporation if we're structuring properly. There, we want all that activity flowing to our personal return. Very different structure.
Via a Wyoming holding company, that's what you'll use to hold those passive investments. Yep.
Exactly right. All going to come through your 1040, and there we would have capital gains if we held it as an investment.
And we touched on this installment sale thing earlier. Just if we can't do installment sales on inventory, that's a flip property in your C corporation. What I think might be happening here, you may have flipped a property in your C corp and the income you're calling it capital gains, but just because that's what you think when you sell a property, right? You just assume it's capital gain, isn't it? But if it's inventory, it would be considered ordinary gain. Benefit though, the C corp's only paying the 21%. Remember, before you pay any tax on any of that income, reimburse yourself for all those expenses. Those are all legitimate business deductions, lowering the taxable income of the business, right? Take advantage of all that first.
And I would just say, jumping back to what you said about the flipping and installment, I think that is probably the most misunderstood area that I see when it comes to flipping. Is most people don't understand you can't do an installment. You can take payments over time. I guess you call that installment, but you have to recognize all the gain in the year you sold it.
And you can't receive a tax benefit, and that's the whole point.
Right, that's the whole point.
Why would you do it?
Is to defer tax.
Right.
So you could be in a situation where if I sell, inventory to Barley for $1,000 a year for the next 10 years, I have to pay tax on all my gain immediately that year. I don't get to wait until he pays me $1,000 over time if it's inventory. So that can be a real stunner to some people. They got this huge tax bill that they weren't expecting. So we wanted to make sure we threw that one out there. I think we're good here.
Yeah, I think so.
All right.
Does the SALT deduction of 40,000 new upper limit, right?
Yeah.
Does that apply to a joint tax return?
It applies everywhere.
Yeah, that's assuming you're talking about a married filing joint tax return here. Yep.
Yep. This comes back from originally $10,000 limit during the Tax Cut and Jobs Act. It got recently upped to 40,000. What is our state and local tax? That's just it.
Yeah.
When we're itemizing the state and local taxes, how much did you pay? And maybe property taxes for your personal residence or something like that. Sales tax could be part of it. If you have any tax based on the value, ad valorem, local taxes. Those are all things that add up, and you were only able to deduct up to 10,000. Now it's 40, and that applies to a married filing joint or a single return. If you're married filing separately, that does get cut in half to 20,000, but it does phase out at $500,000. That is, if your adjusted gross income is over 50,000, then we start to see it reverse a little bit. Basically at 30%, whatever your amount is over $500,000, subtract that away.
500,000.
Excuse me. Yeah, 500,000. Yeah. What did I say? Did I say
50?
Well, yeah, no, yeah, 500,000. So just know that. And
but even after the phase out, you still get the 10, right?
Yeah, we get a basement there, floor of $10,000.
Right.
But you won't go below that. You'll still get your 10,000. Just
so we didn't get as high of an upper limit as we wanted, but we didn't lose the lower limit.
Exactly.
So a little bit of a trade-off there.
Yeah. So for every dollar over $500,000, take 30 cents off that 30,000. That's over 10,000. That's what's going to happen. So by 100,000, basically, it's done.
And for those of you that are following along in the tax returns, Schedule A, your itemized deductions, that's where this will show up, right? Right at the top, there's your medical. Right under the next section underneath that, state and local taxes. That's where that limitation shows up. So for those of you in California or something with an S corp or maybe just a high W-2 paying job, and we had some NFL Terrible.
Yeah.
Brutal.
Oh, yeah.
Brutal.
This was
So
a-
this helps a little bit. It's not going to help with the NFL and NBA players in California, but
Yeah.
it's going to help a lot of us in the middle.
Yeah, and if we go on to the next one, we'll see kind of a
Yeah, here's a fun one.
we'll pull this all together. So if you got that limit of 40,000, is there any way around it? Well, the pass-through entity tax deduction workaround. How does that work for high state tax states like California? Are there any entities that get excluded from this? So our pass-through entity tax, what are we taxing?
Pass-through entity. Well, first we need to define that as to S corp and partnership. And that's essentially they're going to file a tax return with the Fed, but they don't pay tax to the Treasury. They don't pay any federal tax. They might pay state fees, state taxes, and stuff like that. The tax burden is passed through to the owner, a lot like a disregarded LLC kind
Oh,
of.
it is. Yeah.
Yeah. So the pass-through entity is your S corp or partnership. The tax burden passes through to your tax return via Form K1, right? Those of you with a partnership and an S corp know how that works. You get a K1 reporting that income. But the thing that's happening here is on that K1 is all of your income there, and we pay the tax individually on our personal level. What we're proposing here is that we shift a part of that tax burden back up to the entity and actually pay the state. And the states are allowing us to do this now.
Yeah. So if Barley has an S corp, and he's going to have his W-2, and let's say his state taxes are at 40,000. He's maxed out. He's in California, high taxes, but he still has the K1 coming through the pass-through amount, the distribution coming into his 1040. And let's say it's 100,000. If he doesn't do anything, nothing changes. He's limited to 40,000 on the state the SALT tax, and he has 100,000 hitting his return.
Yeah, I'll get that 100,000 income. The additional tax, I won't get any credit for.
Nothing going on there
Right.
for him to help him out. But now if his S corporation pays California, and let's just say it's 10% tax for California on that 100,000, that is the S corporation now pays tax. Wait, you just said they don't pay tax. That's right, but we're doing something different now. Now it's going to pay the state $10,000. That's a deduction at the federal level. So now what's going to come through this 1040 is not 100,000. It's only going to be 90,000 for federal purposes. And California is going to give him credit for that 10,000 being paid. And the delta, whatever is 10%, you subtract that state tax rate, subtract that from its federal bracket. If he's in the 37% tax bracket, he comes out 27% ahead on that 10,000. And that's what your delta, that's your tax savings with this. This is a way around the SALT tax limitation. It's going to come through a pass-through entity. It's going to be your partnerships and S corporations, as you mentioned earlier. They ask if there's certain entities that are excluded. I love the way you're thinking here. You mentioned specified services, trade, or businesses. That's actually a different concept. That comes under another tax strategy called Section 190A. But I like that you're thinking, hey, are there certain things that don't count here? Well, yeah, there are. If you have publicly traded partnerships, they're not going to count. They're not eligible for this. If you have complex entity structures, which we do, we just talked about one, that trading structure. You bring a C corporation in there, that's considered complex by most states. And so now we're not going to be able to take advantage of this. So the trading partnership we talked about earlier could not pay this and take advantage of it typically. It's going to be things like that. Those are, but it's few and far in between. Usually you're going to be able to take advantage of this, but if you have any questions, you just got to ask your tax preparer to see if you're eligible for that.
Yeah, that's a fun one. A lot in there. And it's a I don't know if it's a binding election. It's a what's the word?
It's kind of binding. I think
Yeah,
that's the word.
Yeah, hard to go back on that one. Well, again, of course, if this applies to you, you've heard about this, you think it might apply to your business, let us know, shoot us a question. Again, just to reiterate, pass-through entity tax is PTET, state and local tax is SALT, and then SSTB, specialized service, trade, or businesses there. Any questions on that, please be sure to let us know. Ooh, last one.
Yeah,
Any
this is
questions
the last one.
Want to hit before we move in here? We're doing good.
I think we're good.
Yeah, we don't want to take away from the team there.
Yeah, they've been playing.
Thanks, team.
Yes.
There's Carl. Hey, Carl. Which is owner. Good to see you, buddy. Oh, this is kind of a different one. I like this one. Well, so backing up half a step, the big beautiful bill. A lot of stuff in there that looks like we might get some kind of interesting changes here in this country in the next 10 years or so as far as manufacturing. There's going to be a lot of really interesting manufacturing credits, expansion of qualified opportunity zones into rural areas, I think for that exact same purpose. I think all this stuff is kind of hitting from different angles, all kind of attacking the same basic concept here. One of the things we're looking at is this research and development tax credit. Just FYI, guys, this isn't something our firm really specializes in. As far as your product development, some of you are doing that. It's not something we would. We don't have like a research and development tax department or anything like that in house. But I'm not trying to sell us short here. But we're just trying to give you information on this. Where should we start on this one?
Yeah. So I think the real question is, what happened in the big beautiful bill to this area. And just so you know, there is the tax credit portion. There's also the deductions for expenses. Which is better? Well, it just depends. So we're going to kind of, for a few moments, talk of them together, because the tax credit's built up by how much you expended in that area. Likewise, if you're taking it as a deduction, that's also, again, of course, going to be dependent on the expenditures you have in the R&D area. So we're just going to kind of put them together for the areas here where they kind of mesh, and it's the same topic, if you will, same results on things. We really got to define what that is. And this is going to be your domestic research or experimental expenditures, and how the IRS talks about that. That's anything, for development or improvement costs of a product. Now, it makes a big difference if you're incurring those expenses here in the US versus international. If they're done in the US, you could amortize until recently over 5 years, and that's fine. But it's foreign, it's 15 years, okay? Clearly, they're trying to incentivize, as Barley pointed out, to get things back on shore in this area. Well, now they doubled it down to where you can actually deduct the whole thing right away, 100% of it, and you don't have to amortize over 5 years, again, if it's domestic. So if you have one of these research and development expenditures that are based here in the US, you have the option to do it over 5 years, or you could expend it right away. And that's what this really gets at. Now, if you take the credit, well, tax credit, that just means a direct reduction in your tax liability, as opposed to an expenditure or deduction, which just lowers your taxable income. One's not necessarily better than the other. We often say if you're given the choice, the same dollar amount takes to take the tax credit, because again, that's lowering directly the amount you pay. But you do want to do some research on here, because you might have game plans for 5 years or something like that. You may want to amortize. You may not want to deduct all the time. This is where it takes significant tax planning to see the consequences of your moves. But it's nice to have that flexibility. And this is a big one. Again, it's going to be for certain types of products and things like that. This does not include land. Why? Because we have depreciation when it comes to buildings and things like that. We have sections 167, 168, bonus depreciation, things for buildings and things like that. So we're not going to be able to use that. Likewise, we can't do it in the areas of depletion. If you've got minerals and things like that, we have a whole system to help with that, different part of the code. So this is your machines and things like that, cost related to that, testing and things like that, things that don't count efficiency. If you're looking to see if this new plan will, if you're spending expenditures to see how efficient something new change in your product development is, you can't deduct that. And so the point to that is that this gets really technical, really fast. You're going to want to talk to experts on it to see which expenses do qualify here. It's always going to be in the technical realm. It's not going to count for, if some kind of expense that isn't really related to technology or something of that nature, typically. But again, you want to talk and have it get researched to see what area it will include. But exploration and things like that, that's not going to count. So there's certain limits that they have put to this. Although once we're in there, we're doing a product and we have a technical advance in that product development, more than likely have an R&D going on. If you're stateside, you can deduct immediately or over 5 years. But if it's foreign, it's going to be 15 years. And that's the real key about the amendment that went on here.
And again, I think this is all just to incentivize business. First thing that pops in my head is these chip manufacturers.
No doubt about it. That's part of it.
They want to get these guys in here and invest trillions of dollars and have them be able to take these massive tax deductions. But how does this apply to you guys? Maybe one of you guys is developing an app or something like that. Right? You might incur some of these costs. So we definitely just want to throw it out there.
We have a lot of clients who do software development.
Yeah.
This is exactly built for that.
And was this There wasn't a retroactive part of this, was there? Or there was, and I don't really know how that applies. I don't have enough experience with that, but there is a retroactive portion of that. So if anyone has been doing this for, the last 5 years or so, maybe set up a tax console, see if there's anything that we can help you with there. Um, certainly want to look at any available options.
And I think that's it.
That's it. Well, we got to the end. Have you guys seen this picture yet? Make sure you subscribe. Toby and Clint, you guys know the partners. They're out there doing it. We love them.
Mhm.
Scan the code. You know the deal. Come to our live event. I'll be there Saturday. Elliot will be there Saturday, maybe one of the days, all 3 of the days.
Gonna be there for a bit. Gonna be
Whenever
there.
he can make it, whenever we can drag him down there. And you can schedule a free question right now. Scan that code and take it from there. We can sign you up right now. Yeah, well, we made some pretty good progress today.
We did get those questions in. I will review them. I review every one.
Yep.
No joke. And I want to thank our team.
And our survivors.
Yeah, we got 140 already answered. A couple left there. They're getting that. But again, thanks to Patty running everything. We got Carl in there. Always good to see him. And Dutch, Harry, Jared, Jeffrey, Rachel, Tanya, and Troy.
The big brains are in the back.
Absolutely. Yeah. Kenny and Zion running everything. Appreciate their help.
Yeah, thanks, team. And thanks to all of you. You guys, this is your resource. These are your questions. We kind of, we all try to keep it in the family here. So we really love seeing you guys at all of these different workshops and live events. Just again, Platinum Portal, Platinum Knowledge Room. Please come in 5 days a week. Come join us in there. Ask any questions you have. And we'll see you again in 2 weeks.
Yeah.
All right. Thanks,
Thank you.
guys. Tune in next time.